first I'm going to talk about a company called Latch. And Latch is absurdly overvalued if you look at traditional valuation metrics. But I think it's one of the greatest deals in the market. So it has a price to sales ratio of 68. That is nosebleed by any metric. It also has negative gross margin at the moment. What this means is, so Latch is a smart lock device company, and they are literally spending more on these smart locks than what they sell them for. So they are taking a loss right out of the gate with these things. So on the surface, that makes Latch as a $1.9 billion company look absurdly overvalued. However, you got to understand the context with Latch. So there's a big difference for Latch between revenue and bookings. And when they sign deals with these apartment complexes, these property owners, it's upfront, typically on a new build. And these products are some of the last to go in the building. So they've got to build the building for 6 months to a year to 18 months. They're building these properties, and they already have a contract in place that Latch is going to be installed, but they don't get to recognize that as revenue until the device is actually put in there. So there's a big disparity between the bookings and the sales. Sales are actually a little bit behind expectations right now because there's a slowdown in construction, but bookings are ahead of expectations because they're actually signing more deals than they thought they were going to. The hardware does have a negative gross margin, but Latch also has a growing software business. And the software side of the business has better than 90% gross margins. Over the next few years, the software should make up more than double the revenue of the hardware. So all of a sudden, the margin profile is going to completely flip on its head with Latch. So as you look at this, the revenue is going to come in. They have these really high visibility revenue streams, the 6-year contracts. It's going to come in, and there's also going to be, it's going to flip on its head from from hardware revenue to software revenue. So the margins are going to completely look different. This company is on track to have $249 million in annual free cash flow by 2025. That means that it currently trades around 7.5 times its forward free cash flow. That is quite a bargain if you believe that management can go out there and accomplish this, and if you're willing to hold for the next 4 years, which we believe investors should.
Yeah, I kind of like that Latch is pivoting to office buildings. I'm not sure if you saw this news, but Latch actually recently signed a customer that you might have heard of called the Empire State Building to provide security for its offices. And it's just like really impressive early results with that one.
Yeah, I was so excited about that. I actually made Latch a core position in my portfolio recently.
I had the opportunity to talk to their CEO a little while ago on Industry Focus, and you just get the sense that like this is his baby. Former Apple executive founded the company. I can't say enough good things about Latch. Not a cheap stock. That's the worst thing I could say about it. Which is the reason we're talking about it right now. The one I wanted to talk about is one of our favorites at the Motley Fool. It's a favorite among mine and a lot of our analysts on the team is Upstart, ticker symbol UPST. Upstart's their early results, to say they've been impressive would not be doing it justice. Upstart went public at $20 a share in December. It's trading for about 265 as I'm talking. Already is trading at 13 times its IPO price. By any traditional valuation metric, this looks very expensive. Upstart, unlike a lot of the growthier companies we talk about, is a profitable business, but on a price to earnings basis, it has a multiple of 403 times earnings. 403. And I consider, as the value investor in me considers anything over 20 to be expensive. It trades at 46 times sales, so it's cheaper than Latch on a price to sales basis. But it's still a very expensive company. But this is why we say you need to take into account some of the other metrics. Latch is growing its revenue, or not Latch, Upstart is growing its revenue at an unprecedented rate. It increased its revenue by 61% in the second quarter, not compared to a year ago, compared to the first quarter. So on a quarter over quarter basis, it's growing at more than 60%. Revenue's up tenfold from a year ago. And it has a massive addressable market opportunity. This growth is proving that it can grow into its addressable market. It's just launching in the auto industry. It's just starting to ramp up its auto lending capabilities, specifically in auto loan refinancing, which it can do a much better job of for subprime borrowers than the existing methods. That there is over $1.3 trillion of auto loan debt in the United States. Upstart did $2.8 billion of loan volume last quarter. That's a lot of room to grow, and they're really showing that they can grow into it. So another point I'd like to make, and I'm sure John would agree with me on this, companies like the two we're talking about, a high valuation can be a big competitive advantage, especially when it comes to raising capital. Upstart could raise $1 billion of capital and barely dilute shareholders. Most of its competitors, especially traditional lenders, could not. With Latch, traditional hardware or traditional smart home hardware makers generally cannot raise capital at the valuation they could if they wanted to. They don't need to. They just got a bunch of money from their SPAC. But in a lot of cases, I've said before, Tesla's biggest competitive advantage over auto rivals is its valuation, because it can raise capital for nothing. So it's not just about the numbers. Valuation can be an advantage too, even if it's high.